Hey traders, Chris over here. Welcome back to another installment of my Trading 101 video series. This focus is going to be options trading, and this is going to be installment 4. This is going to be part 4. Part 4, and this one we're going to talk about a long strangle and a long straddle. Stupid names, but serious strategies. Let's get right to it. So if you've been watching the other installments, it's this. My options trading 101. My first video was just simple long call, long puts. My second video was bull put spreads and bear call spreads, i.e. vertical spreads or credit spreads. Then I did a credit spread repair strategy, which talks about using credit spreads to our advantage, owning stock, calculating break even, and then utilizing a covered call strategy if you want to repair the trade and turn a losing credit spread into a winner, which is kind of nice to do. Also, obviously, when you want to own stocks, you can let it run and make 3, 4, 5, 10, 20, $100 a share. But it's just nice to know how to calculate break evens if you're using credit spreads. Let's talk about the long strangle and long straddle. They are pretty similar. They kind of serve the same purpose. What's important to know is just the slight differential between the strike prices. So, long strangle, long straddle, the reason they're called that, I don't know why, because they're stupid names. No, but what I was going to say is the strangle is the following. Basically, what I want to have happen is a long strangle is I buy a call at X strike and I buy a put at X strike, and I'm going to pay a debit for it, okay? The strike prices are different. And in a long strangle, we're going with the direction of the call and the put. So the buy call will be higher, okay? And the buy put will be lower than the current stock price. So I trade these a lot when it comes to earnings plays, okay? Now let's talk about this. The long straddle is very similar. I buy a call at X strike and I buy a put at X strike. And a straddle is the strike prices are the same. That's the big difference, okay? So my buy call is virtually at the money, right? Which means it's roughly the same price as the underlying stock. My buy put is at the money. And also, yes, I'm paying a debit on this. These are both debit trades, okay? So which one is better? It really doesn't matter. The long straddle, because you're at the money or you're closest to the real asset price, the straddles are going to be more expensive, okay? But the straddle gives you a chance to be pretty neutral with the overlying movement. So as an example, let's talk strangle first, then let's talk straddle, because that's how I have them listed right here. So let's use this one. And again, guess what? I'm going to use Apple because I've been using it for every video and it's really simple. So Apple, price is $150 a share. All right. Let's say that Apple has earnings. And we're looking at this on a Monday. And Apple has earnings before market open or after market close. That's the fancy acronym for that. So before market open, after market close, we'll just say that it's going to be an after market close on Wednesday. So if I wanted to set up a long strangle, here's what I'm looking to do. If Apple's trading $150 a share, what I'm going to look at is what is the average earnings move on Apple. And I might look back 3, 4, 5 different earnings reports. How many dollars has it moved? What's the average percent move? And figure that out. Because if we're in a low volatility environment, maybe I take like 50 to 75% of that movement. If we're in a high volatility environment, maybe I just take the entire move. So let's say, again, this is just an example, but let's say Apple's average earnings move is 10%. Okay? So what's 10% of $150 share price? So we can do the math. $150 share price, 10% move, it's a $15 move. So I can expect, within reason, I can expect Apple to hit 135 to the downside, or I can expect Apple to hit 165 to the upside. Okay, so my long strangle, I would do something like this. I'm going to quickly replace this. I was getting ahead of myself and I did the math incorrectly, so just bear with me. Okay, so my long strangle, if I expect the downside 135 or the upside 165, I would look at a trade like this. I would do a buy to open 160 call. I do a buy to open 140 put. Okay, so I'm going essentially out of the money, but I'm taking it based on the average of, I think over the course of 5 previous earnings reports that Apple has moved an average of 10%. So if I paid less than $5 debit, there's a pretty good chance I can make money on this trade. Because if we hit 165 or we hit 135, 165 gives me a $5 premium, right? If we hit 135 from 140, that's a $5 premium. So obviously, if it's trading for $5 debit, I don't really want to take the trade because my profit is minimum. But if somehow this is trading for like $3 debit, that means that if price indeed hits 165 to the upside or hits 135 to the downside or even surpasses that, then I get the extra value and I get the extra profit. Okay, so let's say that I pay $3 for this trade. This is a long strangle. I buy the 160 call and I buy the 140 put. Now you can see that directionally, going back to the original long call and long put video, if price is above my 160 or price is below my 140, there's a good chance I can make money on the trade. But because I'm paying $3, I need it to go, a little bit further down, a little bit further up, and so that's why I have this calculated here. So ideally, if price goes to 165 or 135, that means that I should be able to see a $5 credit. Okay, so let's take this over here. I know I'm skipping around because I've got the little redacted lines there, but let's say Apple gaps up to 165 for Thursday's opening bell. Okay, the reality of that trade is this. My 160 call is worth $5 plus remaining time premium. Because if this was opening bell Thursday, I still have all day Thursday and all day Friday with time in that trade that's still factored into it. So it might be trading for like $5.50, maybe even $6. It's a bigger profit than what I paid for it. If I paid $3 debit and it's now showing $5 and change, that's a net profit on the position. Okay? Now, my 160 call is where I'm going to win on the trade. My 140 call or my 140 put is going to be pretty much worthless. Is worth next to nothing because directionally it didn't move the way I needed it to. So that might be trading for like 1 cent, 5 cents, 10 cents. It's going to be very, very cheap credit wise, but it doesn't matter because the whole point of this trade is if price goes up or down, I'm going to get paid on that volatility. That is what this trade is all about. And the strangle is simply the strike price is at different strike levels, right? So I have the 160 call for the bullish side. I have the 140 put for the bearish side. If price goes through those levels, I keep the premium. And the nice thing is a lot of times earnings like this, this is a fairly inexpensive way to do it. The strangle is cheaper than the straddle because you're out of the money. Because price is trading at 150 a share and I'm going out to 160, I'm going out to 140, and price has to move, $10 and beyond and $10 and beyond. And that's fine. Because if it moves beyond, great. And again, I'm taking the average earnings and all that good stuff. Does that make sense? So a lot of times when I'm trading earnings, I'm doing this. I will take a stab. I'll pay a little bit less because I'll do the long strangle. And if price, has good volatility and it blows through the highs or blows through the lows or hits the averages, as long as I price out these options and I can see if it hits the average of the earnings movement and I can make $1 or $2 or $3 of credit, I'm good with that. And the more expensive stocks like a Meta or a Netflix or a Tesla, sometimes that debit might be $5, $6, $7, $8. But you can also return $2, $3, $4, $5 of credit. So, if you're willing to fork over a $500 risk up front or a $1,000 risk up front, you can still make $200, $300, $400 in profit. In a big move, if we have like this crazy blowout earnings, good or bad, there are chances where you could actually have a 2, 3, 4, 5x return. Case in point, I just this was an example last week in my live trading room. We did a long strangle on Tesla, and we paid like $4.85. It was worth over $13 by the end of the week. So it was like a 300% return if you held it for a couple of extra days. I held it for a day and ended up making like $2.95, which I'm totally happy with. I was risking a max of 485, ended up making nearly $3 a credit. I mean, that's a 75% return. I'm super happy with that. Okay, so again, that's long strangle. So the strike prices are different. It's a directionally neutral play. I want price to go up or down. I don't care what direction. I'm playing it neutrally, but as long as it goes up or goes down and goes through my levels, I have the chance for the long call or the long put to be profitable. Okay? All right, now this should make sense. We're just taking the long straddle, right? The long straddle is strike prices are the same. So Apple again trading at 150 a share. I can do a buy to open 150 call and a buy to open 150 put. Now again, herein lies knowing the numbers. If Apple, okay, let's say this is an earnings play. Apple's earnings average 10%. That means that I've got 165 on the upside. I have 135 on the downside. If my long straddle is going to cost me $15, I don't want to take that trade. Okay? So basically, if I'm going to take an at the money, it's probably going to cost me, $6 to $8, maybe even $10 for this trade. But the probability of profit remains. If Apple hits its average earnings move of 10%, which is $15, if I paid less than $15 on the debit, hang on a second. Sorry, I just had a chart alarm going off. I wanted to not annoy you with that noise. So if I'm paying less than $15, there is a fighting chance that I can turn this into a profitable trade. So more than likely, yes, it's going to be more expensive than the strangle, but I'm trading it at the money, which is why it's more expensive. But I still have the same type of calculation. If this costs me, $10 for the debit, what's my probability if price goes to 165 or 135? I mean, the average earnings have proven over time that, yes, it moves about 10%. So I could take a $10 debit. Let's just say it. Let's say it's a $10 debit for this trade. Okay? And Apple indeed moves to 165 on the upside, or if it was a bad earnings report, move to 135 on the downside. That still gives my 150 call or my 150 put $15 of value, and I paid, let's say, $10 for it. That gives me a net $5 profit. Okay, so if I paid $10 for it, I walk away with $5 profit. That's a 50% profit target. This is why options are nice. You just calculate it. I know for a lot of traders, putting down $1,000 on this trade seems crazy. It seems like a lot of money, a lot of risk. I mean, the odds in this trade, it's like as long as I can price it out and I know the averages, I mean, if I believe that Apple's going to move 10% or more, I'll take the trade. Because as long as I can price it out where if it moves what it says it can move, if it moves what it averages, great. I can still walk away profitable, and that's why I would take the trade. Now, do I want to pay $10 for that trade in order to make $5? It's worth it. But if I don't have the capital to say, look, my max risk is $1,000. If that's too steep, then don't take the trade. Look at the strangle option, pay a little bit less because you're out of the money instead of at the money. Okay, so the straddle, again, pretty simple to follow. This is a very neutral position, but it costs a lot more. So in the event that you take a loss, and not all earnings plays are going to pay out, right? Sometimes there's slippery earnings, sometimes there's low volatility, sometimes there's no volatility, which kind of suck. But the reality is, if you're trading a straddle, it's going to cost you more money, which in turn will probably be higher risk. Okay? So if you don't like the idea of higher risk, then look at the strangle plays and just try to calculate it based on, going out of the money, kind of an equal amount, and make sure that I trade this a lot with my delta traders. We look specifically at pricing them out where it's a 25 or 30 delta. Again, that's all advanced stuff. I'm not here to talk about that right here. Point is, do you now understand the difference between a long strangle and a long straddle and how it pertains to I want to be in a trade. I think it's going to go up or down. I think it's going to go a decent amount up or down. A lot of times this is an easy way to approach earnings season. What's kind of nice is every single week when we have these earnings seasons, you literally have thousands and thousands of companies reporting earnings. Now, it doesn't mean that everyone's going to be worth trading, okay? What I'm looking for is certain stocks that have high volatility, and when they move a lot. In earnings, they can move a ton. Does that make sense? So, point is, I like to trade this, but if we have an earnings season, I'm probably going to take maybe 1 or 2 earnings plays a week, and that's about it. I don't really live and die by earnings season. I typically trade the broader indexes. I typically just focus on the stocks I want to own and work my cost basis on. But for good stocks, I mean, Meta's a good stock. Netflix is a good stock. Nvidia would have been a great stock this year because it's been so volatile. Tesla, if I didn't say Tesla, that's a good one. I might have already said that. Amazon is potentially one, right? I mean, your enormous 8, your Mag 7, your big tech stocks, big movers like that. They all have a good chance to, exceed the expectations positively or negatively, and that gives you a chance to carve out some profits on these straddles or strangles. All right, so I hope that makes sense. Again, pretty good on the timing. All these videos are about 14 to 16 minutes. Leave me a comment, like the video, all that good stuff. Support the channel. I appreciate it. If you have any questions, let me know, and I look forward to seeing you more in my live sessions on youtube.com/Chris Pulver, and make sure to join my Discord channel. The server name is Chris Pulver Trading, and happy trading lots of profits. See you soon.